Hello, in this lecture we will take a look at transactions involving accounts payable. So we will be able to journalize transactions related to accounts payable and describe the effects of each transaction on total assets, total liabilities, owner's equity, and net income. So we've taken a look at cash, we've taken a look at the receivable, now we're going to take a look at the payable cycle. We're going to go through the same set of questions, so we're going to repeat this process once again, asking, is cash affected? Why did we ask that first? Because if cash is affected, we know what will happen to cash a lot more easily because we generally use cash a lot more often, so we'll tend to understand what will happen to cash, and therefore that will help us to understand what will happen to the other accounts. So we're going to ask, is cash affected? If it is it going up or down? Therefore, do we debit or credit cash? If it is not, then oftentimes I would think about what we're going to receive, because what we're going to receive is often either an asset or an expense, which we may have more experience with, so we'll take a look at this in that way. So we purchase supplies on account for $965. So is cash affected? In this case, it is not, because we purchased it on account. Therefore, if we didn't pay cash for it, we could say, well, we paid something. We paid kind of like a liability. You can think of it kind of like a credit card. We're going to think about that account being called accounts payable. We owe something. Now, it's hard to think about accounts payable sometimes because we haven't been dealing with liabilities much at all lately. So we may know that accounts payable is affected, but we might not know which way it should go. Should it go up or down? And so it might be easier to think about what we got. And in this case, what did we get? Supplies. If we have our chart of account, we can take a look at it. Where is supplies? Well, it could be an expense or it could be an asset. In this case, it's actually an asset because we bought the supplies and we have not yet used it. So under an accrual basis, when we buy the supplies, it's going to be an asset. Then as we use it, we will expense it in using it. And that is the matching principle. So in this case, we're going to buy supplies as an asset. The asset here has a debit balance up here just like cash does, and we got more of it, therefore it's going to go up. How do we make something go up? We do the same thing to it, which in this case would be another debit. If we debit supplies, then we have to credit something else, and we already know that the credit's going to be a liability because we just talked about the fact that it's going to be on account because we didn't pay cash. So instead of cash going down with the credit's going to go to a liability, which actually increases the liability. So if we think about it, does it make sense that we credit the liability? Well, these are liabilities. We can see they have credit balances represented by the brackets. The bad thing is going to go up, meaning we owe more money in the future. How do we make something go up? We do the same thing to it, which in this case would be a credit, which we already knew because we debited the supplies. So if we take a look at it here, we're going to say supplies is going up. The debit's going to go on top out of just kind of tradition. The debit's going to go here. If we see the beginning balance plus the debit of $965, that makes the supplies go up to here. The other side being the payable, so instead of paying with cash, instead of reducing cash with the credit, we are increasing the payable. So the liability of a credit balance, we're going to make go up by doing the same thing with a credit. Notice there's no effect on net income because that wasn't an expense, it's an asset. We won't expense it, we won't record the reduction in net income until we use that supply in order to help us generate revenue in the same time period, which is the matching principle. What happens to our accounting equation? Well, the assets then are increasing because we bought supplies and it's an asset. And now we're working with the liabilities here. We can see that the liabilities also increased and there's no effect on owner's equity because there's no effect on the blue accounts down here. Next transaction, paid cash on account for $965. So now we're paying off that transaction. So is cash affected? Yeah, in this case we paid cash. Is cash going up and down? It's going down because we paid it. Cash is a debit balance. We're going to make it go down by doing the opposite thing to it, which in this case would be a credit. So we're going to credit cash, then we're going to debit something. And what are we going to debit? Well, we paid something off on account. So that $965, remember we bought the supplies with that, but we bought it last time, and now we're kind of like paying off the credit card. So that's our accounts payable, representing the fact that we owe money to some vendor, has a credit balance. We're going to debit it because we credited cash, we have to debit it. Does that make sense? Well, it has a credit balance. After we pay it, it needs to go down. The bad thing needs to go away because we paid it off. How do we make something go down? We do the opposite thing to it, which in this case would be a debit. So it would look something like this. We're going to say that cash is going to be credited. It's going to reduce. So here's cash. It's going to go down by that because we wrote a check to here. That's a debit. That's a credit. Makes it go down because it's the opposite thing. Then we've got the accounts payable being a debit. This is a credit. We're going to debit it, making it go down to 0. What's the effect on the net income? In this case, no effect on net income again because it's an asset and liability. No effect on below the blue line, income statement accounts being revenue and expenses. Effect on the accounting equation. Assets are now decreasing because cash is going down, and we're now working with these liabilities, and liabilities are also decreasing because we paid it off. The bad thing's going down. So the good thing's going down, the asset, and the bad thing's going down because we paid off the bad thing, with the good thing. Next transaction, purchase auto service on account for $750. So is cash affected? No, because we purchased it on account. Okay, so then we know that we paid for it with like a credit card. So again, we know that accounts payable is the account that we're going to hit, but we may not know, again, is it going to go up or down because we haven't worked as much with liabilities. So we might want to think about, well, what did we receive? In this case, we received auto service. So if we look at our accounts, auto, we have an auto expense down here. So that's what we got. We got an auto expense. If we look at all the expense type accounts, you can see that they all have debits. They all are debited accounts. They only go up. The auto service guy doesn't pay us. They only go one way. How do I make something go up? We do the same thing to it, which in this case would be another debit. So we know we're going to actually debit the auto expense, and therefore we're going to have to credit something, and of course that credit is to accounts payable. Does that make sense? Well, accounts payable has a credit balance here. The bad thing's going up because we owe more money. How do we make something go up? We do the same thing to it, which in this case would be a credit. So it would look something like this. We're going to say the auto expense is here, and here's the expenses all have debit balances. We're going to debit it, increasing the expenses. What does that do to net income? Brings it down. So remember, net income is the income minus the expenses being a credit winning. So credits of 88,855 minus the debit means that it's bringing net income down. What's the other side of it? Well, we are reducing the bad, we're increasing, the bad things. So the liability is going to go from our credit balance up in the credit direction to 470. So the brackets don't represent a negative number, they represent credits. And what happens to the accounting equation? Well, no assets are affected. You can see up here, no assets affected. We're working on the liabilities here, and now the liability increased because it went up from here to here in the credit direction. How about owner's equity? Well, if liabilities increase and nothing happens to assets, and we're only working on this side of the equal sign, if this increased, that's got to decrease because this accounting equation needs to remain in balance. And that, of course, is what happened because net income went down, which means the total here, which is net income plus the owner's equity, has to go down. Next transaction, purchase meal and entertainment service on account for 1830. So we purchased meal and entertainment on account. So is cash affected? No, because we purchased it on account. So we went out to the restaurant, purchased meals and entertainment for us and our colleagues as a business meal and entertainment, and therefore we put it on the credit card. So once again, we know that it's going to be the payable here. And we probably know which way it's going now, but it might be easier to think about what we got to see which way it's going. We got meals and entertainment. So what do we see here? Where's meals and entertainment? We're going to expense that. Meals and entertainment here. We can see that all expenses have debit balances. They only go one way. The restaurant never pays us. How do we make something go up? We do the same thing to it as what it is. That's a debit. We're going to debit it. We're going to debit meals and entertainment. Then we're going to have to do something to the other side. What is the other side? It's accounts payable. Therefore, we're going to have to credit accounts payable. Does that make sense? Well, accounts payable has a credit balance. The bad thing's going up because we're going to owe more money after this. So how do we make something go up? We do the same thing to it, which in this case would be a credit. All right, so then if we look at the transaction, we can see it here. We can say meals and entertainment the expenses went here, went up. Expenses go up, bringing net income down. Income minus expenses is going down. What happens to the accounts payable? It went from a credit balance here up in the credit direction to a larger credit balance there. And the accounting equation, no effect on assets here. We can see that the liabilities increased, and therefore the owner's equity must decrease. Next transaction, pay cash on account. So this is what's going to happen in accounts payable, right? We're gonna charge up, we're gonna bill it, and that's going to increase accounts payable. And then we're going to pay it at some point, which means kind of like paying off the credit card bill. So is cash affected in this one? Yeah, we paid cash. Cash has a debit balance. It's going to go down because we paid it. How do we make something go down? We do the opposite thing to it. So we're going to credit cash. Then we have to debit something. What are we going to debit? Well, what did we pay off? The bill, the accounts payable. Does that make sense to debit accounts payable? Well, it has a credit balance. If we debit it, we're doing the opposite thing to it. If we do the opposite thing to something, it makes it go down, which makes sense because we paid it off. So there, it would make sense if we take a look at the transaction. We're going to say that accounts payable is here. And so we have the accounts payable has a credit balance, and we are debiting it, making it go down to here. So now we still owe that 1830 that we charged, but we paid off the 470 for the auto service, I believe it was. We still owe the restaurant. And then cash is here, and we're going to credit it, making it go down to here, and no effect on the net income because we charged the auto service when we got the service, not when we paid it. Under the accrual basis of the matching principle, we charged it when we got the service, not when we paid it. So we already decreased our net income by the auto expense in the past. What happens to the accounting equation? Assets are going down because cash went down. Liabilities are here, also decreasing, no effect on owner's equity. So we're now able to journalize transactions related to accounts payable and describe the effects on each transaction in terms of total assets, liabilities, owner's equity, and net income.